Well, welcome back. You're watching NSE Closing Bell, making that attempt for 3100 once again. Interesting dichotomy seen between these two private sector guys, Tata Power and Reliance Infra, with a 4 and a 7% rally respectively, and an NTPC that's down a fair bit in trade today. But it's the three big oil and gas guys, your Reliance, Kane and ONGC, that are really holding up the market. Aneesh Srivastava, CIO at IDBI Fortis Life Insurance, now joins in to talk about trade. Aneesh, thanks so much for joining in. What is your sense going to 2009? DIs like yourself had pumped in about 72,000 crores in a falling market last year. Right. Going into these levels in 2009, how much do you sense that cash allocation would be to equities this year, and what's the outlook in general?
As far as the outlook is concerned, I would like to express like this, that today most of the global economies are getting into recession, and to counter this trend, unprecedented fiscal and monetary steps are taken by most of the central governments and as well as the central banks. Historically, it has been seen that fall in the interest rates leads to some kind of a recovery in real economy. So it's very difficult to believe that when such strong actions are taken, no positive signs would be reflected. My sense is that perhaps there would be some positive vibes coming in, maybe 6 months down the line. If you see the history of the US markets, in last 80 years approximately, we have seen 16 recessions, and barring 1930 recession, most of these recessions were lasting for around 13 months. Some of the research agencies have suggested in US that US entered into recession in sometime in December 2007. So considering that, my sense is that somewhere in next 2 quarters, perhaps some kind of stability should be coming in, and then from there we would start improving. Coming over to Indian macroeconomic scenario from there, there are two key factors in India. One is that India is the net importer of commodities, and second is that India is also a net importer of capital. As far as commodity prices are concerned, as far as crude prices are concerned, they have corrected substantially, and that has benefited India. Had crude remained at $145, perhaps India's FY010 current account deficit would have been 5.5% of GDP. With these levels, perhaps we would be around 1.5% of GDP. Similarly, India is net importer of capital. Now, globally, central banks have cut the interest rates, so there is a very strong possibility that we would be getting in low-cost capital. As of now, liquidity is tight, but over a period of time, I am sure that this scenario would also improve. So in this kind of a scenario, when perhaps macros are a little turning favorable for India, I think India should be doing relatively better than many of the economies. Coming specifically to the stock market, my sense is that there would be 3 phases in the stock market. First phase is when we have seen markets had gone down to 7,700 levels and then recovered, which means that there is a multiple expansion phase which is going on from say 8 times to 12 times multiple. Post this phase, there would be a second phase, once perhaps there would be a stability of earnings happening, and hence next phase of growth would be coming in, which would be perhaps 6 months down the line, when earnings further expansion, once there would be a clear visibility, then perhaps further expansion of multiples from say 12 times to 15 times. So these are the 3 phases how we would see that the markets moving up. As far as if we divide this whole year into 2 parts, first part would be when perhaps there would be lack of visibility, a lot of bad news coming in, hence perhaps markets may remain range bound. But subsequent to that, perhaps
Aneesh, so just to step in from what we've seen up until now in January, where do you think the market is at this point, and what do you expect to see for the first quarter even? Do you expect to see more strength for the market, or generally consolidation at the gains we've made till now?
My sense is that there would be a consolidation happening because first quarter earnings perhaps would not be so good. So in that kind of a scenario, markets can move up marginally, and subsequently there would be a consolidation phase between 9,000 to 12,000 levels.
Shashank, up until the end of the fiscal year anyway, we can more or less strike out any fiscal action. How much more teeth do you think any monetary action has? Do you expect to see a lot more from that front, or do you think we've probably seen the big chunk of it?
I think though I think more is expected out of RBI in terms of, repo rate cuts, and even CRR cuts have been expected. I think most important point here is to really look at whether commodities come back with a vengeance. See, commodities have actually gone down substantially, And somewhere I think across the world we are actually saying that because economies are in a bad shape, commodity prices may not really look up because there is not adequate demand for these commodities. But my sense is that I think further action from RBI would be linked to what sort of change happens on the commodity front. If oil continues to go up, or for that matter metals again start moving up, or for that matter agri commodities start coming back, clearly it's not going to be leaving too much room for RBI to really cut rates further. Though again inflation being an optical number will still continue to go down, while the reality would be quite different as commodities start moving up. So I'm not sure whether inflation will get impacted substantially by commodity prices, but psychologically definitely it's going to have a lesser room to really act upon. So long as commodities remain low, great. I think RBI will continue to do its good work what they have been doing in the last 3 months, and we'll get more liquidity and clearly head towards lower interest rates. But I think it all hinges on the commodity prices from here on.
Okay, let's take a break on that note. As we speak, 3100 is here for the first time today in trade. The Nifty has gotten to that level. The Nifty gainers should come up on your screens because metals have actually, they're the ones who've driven the rally in this last 1 hour at any rate. Sterlite is now at the high point of the day. That's up 10%. Tata Steel, another heavyweight, has had a good session. That's up 6.5%, which is why the Nifty has managed to cross that 3100 mark. We've tended to obsess with it because it's been an important trading level. So if we can close above it, that should go down as a big positive for the bulls. Put call ratio just inching up higher as well. Last half hour to go. We're going to come back. 3100 on the Nifty.